In today's rapidly evolving market environment, efficiency ratios have become paramount in determining whether a company's growth is truly sustainable or merely precarious. The transition from focusing solely on total value to understanding the intricacies of acquisition efficiency marks a significant shift in strategic perspective, a necessity in the volatile market of 2026. This narrative explores how these mathematical guardrails define the sustainable growth threshold for modern organizations. The first and perhaps most fundamental metric to assess scalability is the lifetime value to customer acquisition cost, LTV/CAC ratio. This ratio represents the total economic value derived from a customer relative to the cost incurred in acquiring that customer. A targeted LTV/CAC ratio of 3 to 1 signifies a boundary between healthy scale and risky expansion. A business operating at a ratio of 1 to 1 expends as much to acquire a customer as it gains, thereby nullifying the opportunity for profit once indirect costs are considered. Conversely, a ratio exceeding 5 to 1 might signal underinvestment, implying that competitors investing more aggressively may soon erode your market position. Thus, the LTV/CAC ratio is not just a profitability measure, but also a market defense mechanism. Delving deeper, the customer acquisition cost, CAC, payback period offers a temporal dimension to efficiency analysis. This period quantifies the number of months required to recuperate the acquisition expenditure from a customer's net revenue. In high-performing software as a service, SaaS, enterprises as of 2026, a payback period under 12 months is the distinguishing line. A shorter payback period amplifies capital velocity, meaning that funds are returned and can be reinvested within the same fiscal cycle, accelerating the virtuous loop of growth and reinvestment. When payback extends too long, organizations are at risk of capital lockup and diminishing returns. The SaaS Magic Number stands out as an incisive tool for evaluating the efficiency of sales and marketing engines. It is computed from the quarter-over-quarter change in annualized recurring revenue, divided by the marketing spend of the previous quarter. An ideal magic number of 1.0 or greater signals efficiency, directing businesses to expand their sales efforts confidently. However, a value below 0.5 is diagnostic of systemic issues, a leaky funnel that demands attention lest further scaling multiplies inefficiency rather than value. Underlying these metrics is the principle known widely as the Rule of 40. This ratio mandates that a company's combined annual growth rate and profit margin should surpass 40%. This synthesis forces businesses to confront tough realities. High growth with negative margins may be tolerable, but slow growth must be compensated with positive margins. The Rule of 40 is thus not merely an accounting exercise, but a philosophical stance against unchecked growth addiction, as it continuously draws focus to the interplay between scale and sustainability. At the foundation of all these ratios is the discipline of unit economics. By scrutinizing the profit margins and costs associated with servicing a single customer, organizations can forecast scalability and viability. Negative unit economics serve as a stern warning. Scaling in such circumstances only hastens the journey to insolvency. A sustainable growth threshold is achieved only when each marginal customer reliably contributes more in revenue than they consume in acquisition and support costs. In summary, the landscape of 2026 demands more than growth. It requires intelligent growth. Efficiency ratios, including the LTV/CAC ratio, CAC payback period, SaaS Magic Number, Rule of 40, and careful attention to unit economics, collectively serve as strategic guardrails. They not only prevent reckless expansion, but also optimize reinvestment, competitive defense, and long-term sustainability. As companies move beyond the era of growth at any cost, those who master these efficiency metrics will emerge as the resilient leaders of their industries.